Today, I'm going to explain the powerful relationship that China has with silver and what just happened while you were sleeping in the Asian session today, January 8th, 2026. My name is William Lee, but you can call me Bill. And by the end of this video, you're going to understand exactly why China is dominating the silver and gold markets right now, why the highest volume in billions of dollars happens during Asian trading sessions, and why the move you just witnessed from $79 down to $75 is not a crash. It's a strategic accumulation before the real movement that will take silver to triple digits. Let me start with what happened overnight, because this is critical. While you were sleeping, while the Western markets were closed, while American traders were tucked in their beds, dreaming about their positions, China moved the silver market. They moved it hard. Silver opened the Asian session around $79 per ounce. And by the time Shanghai closed this morning, we were trading at approximately $75, a $4 drop in a single overnight session. $4. Now I can already hear what some of you are thinking. Bill, silver is crashing. China is dumping. The bull market is over. I should sell everything. Stop. Right there. Take a breath, because what you just witnessed is not a crash. It's not panic. It's not the end. What you witnessed is China collecting liquidity before they launch silver into the stratosphere. This is the setup. This is the accumulation phase. And if you understand what's really happening, you'll recognize this as the opportunity of a lifetime, not a reason to panic. For weeks now, if you've been paying attention to volume data, if you've been watching when the real money moves, you've noticed something striking. The highest volume, the biggest moves, the most significant price action in silver is not happening during New York trading hours. It's not happening when CNBC is on the air. It's not happening when American retail traders are at their computers. The real game is being played while you sleep. The Asian session is where billions upon billions of dollars are flowing into and out of silver. And who controls the Asian session? China. China is dominating silver and gold right now. Not just participating, not just influencing, dominating. They're growing their position with a speed and scale that dwarfs anything the West can do. And they're manipulating the price at will. They can move silver up $5 in a session. They can drop it $4 the next night. They have that much control, that much capital, that much strategic focus. And what happened last night is a perfect example of how they operate. Let me explain the strategy, because once you understand it, you'll never panic sell again. China doesn't trade silver like Western speculators. They're not trying to catch a 5% swing for a quick profit. They're not day trading. They're not emotional. They're executing a multi-year, multi-trillion-dollar plan to control the most strategic industrial metal on Earth. And that plan has phases. Phase 1 is accumulation at low prices. China has been accumulating silver for years while the price was suppressed below $30, below $40, below $50. They were buying quietly, massively, without making headlines. Phase 2 is allowing the price to rise to shake out weak Western holders and attract speculative money. This is what we saw from $60 to $83. The price rose, Western traders got excited, FOMO kicked in, and billions of dollars of hot money flooded into silver. Phase 3, and this is where we are right now, is the shakeout. Drop the price violently to trigger stop losses, create panic, force liquidations, and collect all that silver back at a discount from the weak hands who can't stomach volatility. And then phase 4, which is coming very soon, is the launch. Once all the weak hands are gone, once all the stop losses below $75 have been triggered, once retail has panic sold and institutions have covered their shorts, China removes the selling pressure and lets the market do what it wants to do naturally, which is explode to triple digits on the back of physical shortages and unprecedented demand. This is not speculation on my part. This is documented behavior. We've seen China do this exact playbook with rare earth elements. We've seen them do it with copper. We've seen them do it with every strategic commodity they've decided to control. And now they're doing it with silver. The pattern is always the same. Accumulate quietly, let price rise to attract attention, shake out the weak, then dominate the supply, and watch the price moon as everyone realizes China controls access. Now, let me give you the historical context, because China's relationship with silver is not new. It goes back centuries, and understanding this history will help you understand why China takes silver so seriously today. For most of its modern history, China's economy ran on silver, not gold. China's taxes were paid in silver. Big transactions were settled in silver. Trade balances were denominated in silver by weight, not by face value. Silver was China's money. And because of that, China became one of the biggest consumers of silver the world has ever seen. From the 1500s through the 1800s, huge amounts of silver flowed into China. If you wanted access to China's production, because China was and still is the factory of the world, silver was what you had to pay. This wasn't just about money. Silver stabilized their economy. It stabilized their incomes, their prices, their taxes. The system worked beautifully for hundreds of years, but there was one big problem. and that problem was exposed in the 1930s. In 1934, the United States passed something called the Silver Purchase Act. It forced the U.S. government to buy huge amounts of silver. And what did that do? It made the price of silver skyrocket. Now, for a country based on a silver monetary system, that was catastrophic. As silver prices went up, silver was pulled out of China. The money started to leave the country. The money supply that was supposed to fuel their economy started to collapse. Deflation set in. Prices started falling. And deflation, while it sounds good at first, is an economic death spiral. If people expect prices to fall tomorrow, they stop spending today. They stop investing. They stop hiring. The economy eats itself. So in 1935, China officially abandoned the silver standard and moved to a paper currency system. Not because silver failed them as money, but because China learned a lesson they have never forgotten. If your economy depends on a material you do not control, other nations can and will weaponize it against you. The United States used silver as an economic weapon against China in the 1930s. And China has spent the last 90 years making sure that never happens again. In fact, they've flipped the script. Now China is the one controlling strategic materials. Now China is the one who gets to decide who has access and who doesn't. When you understand this history, everything China is doing today makes perfect sense. On January 1st, 2026, China reclassified silver under their dual-use export control rules. What does that mean? It means silver is no longer treated as just a commodity. It's now classified as a material that can be used for military and strategic purposes. And once something falls under that category, exports are no longer automatic. They require government approval, license, permission from Beijing. This is brilliant strategy because if China outright banned silver exports, like they've done with Bitcoin multiple times, it would create massive backlash. The US president would be on TV threatening retaliation. Other countries would react, markets would panic. But by simply relabeling silver as strategically important, China can claim they're not attacking anyone. They're just regulating something critical to their national security. In practice, though, the rules are written so specifically that almost no one will qualify for export licenses. Only the biggest producers might have a chance, and even then, approvals are completely at the discretion of the Chinese government. What this does is close an open market and start gatekeeping. And China is uniquely positioned to do this because they sit in the middle of the global silver supply chain. Most silver is not mined on its own. It's produced as a byproduct when companies mine for other metals like lead, zinc, and copper. And once silver is extracted, it has to be processed, refined, separated, and a huge percentage of that refining happens inside China. So even if silver is mined in Mexico or Australia or Peru, there's a very good chance it still passes through Chinese infrastructure before it becomes usable metal. And starting January 1st, 2026, China gets to decide whether that metal leaves their borders or not. This gives them extraordinary leverage. Control the refining, control the export, control the price. China has done this before with rare earth elements. Today, China controls roughly 80 to 90% of global rare earth refining. They reclassified rare earths as strategic in the early 2010s. They implemented export quotas and licensing rules. Prices went way up. Western governments panicked. And only then did the US, Europe, and Japan realize that rebuilding their own refineries was not a short-term problem. In many cases, it took more than a decade to partially rebuild non-Chinese supply chains. What we're seeing with silver today is the exact same playbook, but with one major difference. Silver is not a specialty metal used in niche applications. Silver is used everywhere. Solar panels, electric cars, data centers, military electronics, satellites, 5G infrastructure, medical equipment. It's one of the best electrical conductors on Earth. And unlike gold, when silver gets more expensive, industries don't stop buying it. They can't. They have to use it. This makes silver's demand what economists call inelastic, rigid, unresponsive to price. Think about it like this. If coffee doubled in price, some people would just drink less coffee. That's elastic demand. But if insulin doubled in price, diabetics would still buy it because they need it to survive. That's inelastic. Silver demand is inelastic because modern industry cannot function without it. You cannot build solar panels without silver paste. You cannot manufacture smartphones without silver. You cannot produce electric vehicles without silver. The factories don't shut down and wait for the price to come down. They pay whatever the market demands. This is why China's move is so powerful. They're not just controlling a commodity. They're controlling a material that the entire modern economy depends on. And they're doing it at precisely the moment when demand is about to explode. Over the next decade, demand for silver is expected to surge because of AI, robotics, automation, green energy transition, military modernization, all the things governments want to control, all the things China is already leading in, and now they control access to the material that makes all of it possible. So with that context, let's talk about what happened in the Asian session last night. Silver opened around $79. And over the course of several hours, it was methodically pushed down to 75. This was not organic selling. This was not retail panic. This was coordinated, strategic, high-volume selling designed to accomplish specific objectives. What objectives? Triggering stop losses, collecting liquidity, shaking out weak Western holders, and accumulating more physical silver at discounted prices. Here's how it works. The market makers in China can see where all the stop losses are clustered. They have sophisticated software that shows them the order book. They know that Western retail traders have their stops sitting at $78, $77, $76, $75. Billions of dollars in automatic sell orders just waiting to be triggered. So what do? They drop the price from $79 to $78. Boom, first wave of stops hit, market sells, price drops to $77. Boom, second wave, more forced selling, price drops to $76. Third wave, and by the time they hit $75, every weak hand has been liquidated. Every stop loss has been triggered. Every trader who was using tight risk management has been forced out of their position. And who's on the other side of all that selling? China. They're buying every single ounce that retail is dumping. They're accumulating at 76, 75, 74. They're filling their vaults with physical silver that Western traders just gave them at a discount because they got scared by a $4 move. This is liquidity collection at an industrial scale. This is how nations accumulate strategic resources, not by chasing prices higher and telegraphing their intentions, but by creating panic, forcing liquidations, and buying when everyone else is selling. And here's the key insight you need to understand. This behavior has been consistent for weeks now. If you look at when the highest volume occurs in silver trading, it's overwhelmingly during Asian sessions. Not New York hours, not London hours, Asian hours. Specifically Shanghai trading hours. This tells us that the real capital, the smart money, the strategic money is Chinese. Western markets are increasingly just following what Asia does overnight. The price discovery is happening in Shanghai, not in New York. And the pattern is clear. Asia accumulates during Western panic. Asia sells during Western euphoria. When New York gets excited and FOMO buys silver at $82, Asia sells to them. When New York panics and dumps silver at $75, Asia buys from them. It's a perfect wealth transfer mechanism. Emotional Western money flowing to patient Eastern accumulation. This is how empires shift. This is how economic power moves from west to east. Now, some of you might be thinking, but Bill, if China is so bullish on silver, why would they drop the price? Doesn't that hurt their existing position? No, because China is thinking in decades, not days. They don't care if silver is at $75 or $79 today. They care about owning as much physical silver as possible before the world wakes up to the shortage, before the COMEX defaults, before Western governments realize they've been outmaneuvered. China is willing to push the price down temporarily if it means they can accumulate another 50 million ounces from panicking Western traders. And there's another reason China might be comfortable with lower prices right now, because lower prices accelerate the closure of marginal mines. Remember, roughly 70–80% of silver production comes as a byproduct of mining other metals like zinc, lead, and copper. When silver prices drop, it doesn't immediately increase supply. In fact, it can decrease supply because mines become unprofitable and shut down, and every mine that closes is one less source of silver that's not under Chinese control. China may be deliberately keeping prices low enough to bankrupt Western mines, forcing them to sell assets or partnerships to Chinese companies at distressed prices. This is economic warfare at the highest level, but it's also incredibly bullish for silver long term, because eventually the accumulation phase ends. Eventually China has enough, eventually they stop suppressing the price and let it run. And when that happens, when Chinese selling pressure is removed and only Chinese buying remains, the price doesn't just go up, it explodes. It goes vertical, because there's no supply available to meet demand. The COMEX vaults are empty. Western mines are closed, and the only entity with significant physical silver is China, and they're not selling. Let me show you what this looks like in the data. On December 24th, physical silver in the Shanghai market closed at approximately $78 per ounce. At the exact same time, silver on the COMEX market, the main Western futures exchange, paper silver, closed at about $72 per ounce. That's a $6 premium for physical silver in Shanghai. Historically, the premium between these two markets is less than $1, rarely more than $2. Why? Because of arbitrage. Traders buy where it's cheap, sell where it's expensive, move the metal, and prices converge. But when there's a $5, $6 gap that persists for hours or days, especially during low liquidity periods like the holidays, it tells us that arbitrage isn't working. Physical silver is not moving freely. And the reason it's not moving is because China isn't letting it leave. The export controls are already having an effect. Shanghai pricing reflects the real cost of physical deliverable silver inside China. COMEX pricing reflects paper contracts that will never result in physical delivery. The two systems are decoupling, and when paper and physical completely divorce, the paper price becomes meaningless. Only the physical price matters, and that price is set in Shanghai. This chart of COMEX registered silver inventory tells the story. Registered silver is metal that's available for delivery if someone wants to settle a futures contract with actual physical. The trend over the past year has been clear. Physical silver has been flowing out of Western vaults, not building up. COMEX currently only has about 130 million ounces of registered silver available for delivery. That's only about 10% of annual global demand, which is 1.2 billion ounces per year. What this means is that if even a small percentage of futures contract holders demanded physical delivery simultaneously, COMEX couldn't deliver. They don't have the metal. The system is fractional. It's built on the assumption that most contracts will be cash settled, not physically delivered. But what happens when behaviors change? What happens when China, or the Pentagon, or solar manufacturers start demanding physical delivery instead of accepting cash? The system breaks. Force majeure gets declared, and the price of physical silver gaps up to reflect actual scarcity while paper contracts become worthless. We're watching this play out in real time. The Shanghai premium over COMEX is the early warning signal. It's telling us that physical silver is more valuable than paper promises, and that gap is widening because China is making sure physical stays in China while the West trades pieces of paper. This is why the overnight move from $79 to $75 doesn't scare me. This is why I'm not panicking, because I understand what's happening. China is using Western paper games against the West. They're letting COMEX set a fake low price, and they're using that price to accumulate physical metal from anyone stupid enough to sell. Now, let's talk about why silver specifically matters so much to China's grand strategy. It's not just about making money on price appreciation, it's about control. China learned almost 100 years ago that if your economy depends on a material you don't control, other nations will weaponize it against you. The United States did exactly that with the Silver Purchase Act of 1934, and China has spent the subsequent century making sure they're never vulnerable like that again. Today, China is implementing the same strategy in reverse. They're positioning themselves to control materials that the modern world cannot live without. Gold is about bringing back trust in money. It's about backing a reserve currency with something real. That's why China spent decades building the Shanghai Gold Exchange, expanding the gold corridor, and publicly buying as much gold as possible. They're telling the world, if you want a monetary system outside US dollar control, we have a solution. A currency backed by gold, stored in your country's or ours, usable as collateral under Basel III rules to borrow money for development. But silver plays a different role. Silver is not about trust in money. Silver is about controlling a critical resource that makes the world work. And because China now controls most of the refining, processing, and now the export rules, China will have enormous say over who gets access to this material and who doesn't. This is leverage, real geopolitical leverage. Not military threats, not sanctions, just quiet control over a supply chain that every advanced economy depends on. And China is doing this with multiple materials simultaneously. Rare earths for electronics and military applications, lithium for batteries, cobalt for electric vehicles, gallium and germanium for semiconductors, and now silver for everything from solar panels to weapon systems. This is the BRICS strategy in action. Build trust with gold-backed money. Control the materials the modern world needs, and use that leverage to reshape global power dynamics away from US unipolarity toward a multipolar world where China has veto power over who gets to build what. So when I look at last night's move from $79 to $75, I don't see a crash. I see phase 3 of a multi-year plan, the shakeout phase. China is removing weak hands from the market before phase 4 begins. And phase 4 is the launch, the real move, the one that takes silver from $75 to $100 to $150 to $200 and beyond as the world wakes up to the physical shortage and realizes China controls supply. How do I know phase 4 is coming? Because the fundamentals haven't changed. Did solar panel production stop? No, it's accelerating. Did electric vehicle manufacturing stop? No, it's growing. Did AI data centers stop being built? No, they're multiplying. Did the Pentagon cancel their $7.4 billion silver smelter project? No, they're pouring concrete. Did global mine production suddenly increase? No, it's declining. Did COMEX vaults magically refill? No, they're still draining. Nothing fundamental changed last night. The only thing that changed was sentiment, and sentiment is temporary. Math is permanent. The math says demand exceeds supply by 200 million ounces per year. The math says COMEX registered inventory will hit zero within weeks at current drain rates. The math says China controls refining and export. The math says there's no cavalry coming to save Western silver shortages, and math always wins eventually. So here's what you need to do. Don't panic, don't sell. Don't let a $4 overnight move shake you out of the most asymmetric trade of the decade. Understand that this is manipulation, yes, but it's manipulation in service of accumulation before the real move. China is not dropping silver from $79 to $75 because they think it's going to $50. They're doing it because they want to own more ounces at $75 before it goes to $150. If you're holding physical silver, you do absolutely nothing. You don't check the price every 5 minutes. You don't panic when you see red. You understand that you own a strategic resource that major world powers are fighting over, and you wait patiently for the repricing event that's coming. If you're trading paper silver, you need to have a wide stop below $60 or $50, not $75, because they will hunt anything tighter. And if you don't own silver yet, last night's drop to $75 is a gift. It's your chance to get in at a discount before Phase 4 begins. Watch the weekly close. Watch whether silver holds above $75 by Friday. That's the line in the sand. Above 75s and the trend is intact. Below 75s and we might see one more flush to $70 to grab the last pool of liquidity before the launch. But either way, the destination is the same. Triple digits, because China's plan doesn't work at $75 silver. Their plan works when silver is 150 plus, and every Western manufacturer has to beg Beijing for access to metal. They need to keep their factories running. This is the new world order being built in real time. Not through military conquest, through control of strategic resources. China learned their lesson in the 1930s. Now they're teaching it to the West, and silver is the classroom. Don't panic. Stay calm. Hold your position, because the greatest wealth transfer in history is underway, and you're on the winning side if you just have the patience to see it through.